Hey, what's going on? It's Nick from Ways of Wealth. Thank you for tuning in. Quickly, before we get into the video, I'd like to ask you if you learned something new, give me a thumbs up. Let me know what you learned down in the comments. I'd appreciate that. And without further ado, let's hop right into it. And today's video is going to be about how to determine if the dividend is safe. There is no better feeling in the world for me when I see my account and I see a dividend payment has come through. That's so awesome for me. And I'm just going to run down some of the criteria that I go through when I'm researching my companies, and I thought I'd share it with you. For those newer investors who are not familiar with a dividend, it's a payment made out by a company to its shareholders based on the earnings that they had in the previous year. So they'll give you a portion of their earnings to incentivize you to be an investor. And these dividends are normally paid out either yearly, bi-yearly, most are quarterly, and some are even monthly. So that's something to watch out for. These normally happen with companies that are more mature, so companies that have already established their customers, already established the sector that they're in. Whereas growth companies would reinvest this money in R&D to help, push that company to the next level and push them into the mature section of the product life cycle. With that being said, the first thing that I like to take a look at is the product life cycle. I want to know where that company is. Are they on their way up, or are they on their way out? You don't want to be investing in a company that is mature, on the end of their product life cycle, companies like Blockbuster or a newspaper company, because those businesses are losing earnings year over year. And if the earnings are declining, then they'll have less money to pay in dividends, which will either lead to a decrease in dividend payment, or they'll have to cut that dividend completely. So that's something that I look for. I'm looking for companies that are in the mature phase. They're companies that provide products that you use on a daily basis. Those are the industries that I'm looking at when I first start my research. So once I found a company that's in the mature phase, one that kind of meets the criteria of, I see these items on a daily basis, my next step is to take a look at the dividend history. First things first, how long have they been paying that dividend? And the second thing that I'm looking at is how often they increase that dividend. Are they increasing it every year? Is there periods where they've had to pull back? Those are kind of some of the key indicators of how the business is doing currently and how they've kind of performed over the past 10 years or so. It's important to note the companies that have previously cut their dividend. These companies are unfortunately likely to be repeat offenders. They're likely to cut the dividend again in the future, so that's something that you should take note of and be wary of for sure. That's where I would definitely suggest starting with the S&P Dividend Aristocrat Index. These companies are companies that have increased their dividends for many, many years, and there's 3 criteria that you need in order to qualify for this. And the first one is 25 years of consecutive dividend growth. That for me shows, through thick and thin, these companies have continually increased their dividends in order to attract investors and keep their shareholders happy. The second is that they have to trade on the S&P index. And the third is that their market cap has to be a minimum of $3 billion. And some of these companies you might have heard of. One of them's McDonald's. Another one is Walmart. If you like the REIT space, Realty Income is another, and everybody knows 3M as well. So those are a good starting point to see companies that have continuously increased their dividend payments over a long period of time. And if you want to take it one step further, there's Dividend Kings, and those have one criteria, and that is increase your dividend for 50 plus years. They don't have to trade on the S&P, but that's a pretty amazing feat. Believe since the last time I checked, there was 28 companies that fit into the title of Dividend King. Some of them are Procter & Gamble, Coca-Cola, Definitely worth looking through the list, but obviously not every company has been around for so long. So kind of my minimum requirement is 10 years. I want to see 10 years worth of financial history of a company before I'm going to invest. Anything else is speculation and not what I consider to be investing. But I want to see over the past 10 years, has that company continuously made an effort to keep the dividend stable or increase it? So there's the dividend king, the dividend aristocrat, and then obviously my minimum requirement, which is increasing the dividend over the past 10 years. The next step in determining if a company's dividend is safe is calculating the payout ratio. Now, in simplicity, what that is that's calculating how much of the earnings is the company paying out in a dividend. And that could be calculated by taking the total dividends and dividing it by the net income. Anything greater than 100% on the payout ratio is a red flag. This means that the company is paying more dividends than they're actually earning, which eventually is going to lead up to either them having to reduce the dividend or they're going to have to cut it out completely. So that's something to watch out for. The next thing is to see how that payout ratio compares to other companies in the industry. What other companies in the sector are paying dividends and what did their payout ratios look like? So not only am I seeing that they can sustain the dividend with the amount of earnings that they're making, but I'm also seeing what their competition level is like with, other companies that compete, same products, same sectors, same industry. It is also very important to go back and see what the long-term average payout ratio is for the company. So like I mentioned before, we're going to go back and we're going to take a look at 10 years worth of financial history, and we're going to see where that payout ratio has been 10 years ago. We're going to see what it is 5 years ago. We're going to see what it was 2 years ago. We're going to see what the 10-year average is and where it sits today. Is the payout ratio itching towards that 100% mark where it becomes a red flag? Or does it float around the average, which means that it checks off that payout ratio box? Now, something else to consider for you dividend ETF investors, definitely make sure that the percentage yield that you're getting on the dividend is not greater than the dividend that they are receiving. Keep the ETF in check with what their payout ratio is. So far, we've covered the dividend payment history, and we've covered the payout ratio, and the third thing I want to talk about is the corporate debt. How much debt does that company have on its balance sheet, and how have they done in order to pay that back, and is it going to be a problem in times like today where companies are struggling with bringing in that cash flow in order to pay for business operations, avoid filing bankruptcy, and avoid cutting dividends? So the way that I do this is through another ratio called debt to EBITDA. And if you're not familiar with EBITDA, it's earnings before interest, depreciation, and amortization. And what this is telling you is how much the company is bringing in order to pay down that debt. Now, as I mentioned with the payout ratio, it's best to compare the past 10 years worth of data. What does that debt to EBITDA ratio look like over the past 10 years? Take that average and take a look at where the company is right now. Furthermore, we're going to take a look at what the debt to EBITDA ratio is for other companies in the same sector and the same companies that we looked at before. And we're going to see where those averages lie. We're going to see strengths and weaknesses across the sector. As I mentioned with the payout ratio, the first thing that I do is I take a look at the past 10 years of data and I get the average of what the debt to EBITDA ratio is for that particular company. And if you see a number that is decreasing over the past 10 years, means that they're doing a great job of paying down that debt. And on the flip side, if it's increasing, you know that they're having a little bit of challenges. And when that debt's increasing and they're not able to pay it back, it's either a decrease in earnings or again, one of these yellow or red flags that kind of make you hold back and say, is this a company that I want to be investing in, especially if it's for the dividend? Now what you're going to do is once you've figured out the own company situation, you're going to use the competitors that you used before. You're going to calculate what their debt to EBITDA ratios are, and you're going to see strengths and weaknesses, which ones are faring better than others, and maybe potentially, a company that you identified in the beginning that you didn't think of is now obviously becoming the main contender for you to be a shareholder. Now that is why research is so important, and those are my three main indicators that I'm looking at when I'm trying to see how safe the dividend is. And it's important, but you'll learn along the way that everything's not perfect. My biggest learning lesson has been in the commodity sector. I made an oil position a couple months ago. I learned that the cyclicality of the business, the up and down, it makes it so hard for these oil companies to withhold the dividend. So I've learned to stay away from the commodity side, and I would definitely urge the same for you. Another, potential downfall is when new management comes in to take over a company. They could cut the dividend and they could place the blame on the previous management and use that kind of going away for them to say, hey, you know what, we didn't like the direction that they were going, we're going to take the capital, we're going to reinvest it in the company. And if you're looking for dividends, and that's something to be aware of, is when that management transitions and new people come in and take over. Now, with all that being said, I'd be completely naive to tell you the dividend will be 100% guaranteed after you've checked off all these boxes. What we're doing by researching and figuring out more about these companies is we're trying to mitigate as much risk as possible. Unfortunately, nothing is 100% guaranteed slam dunk, but if you can minimize as much risk as possible, it's going to put yourself in a better situation moving forward. And that's it for this video. If you learned anything, please give me a thumbs up. It helps me grow. Let me know what you learned down in the comments. Don't forget to subscribe and turn the notification bell on so you get notified when I premiere my next video. Happy trading.